Welcome to SciFlux. Here, you get daily coverage of the latest scientific research. Every day, we bring you new research in a clear and simple format so you can stay informed without wasting time. Like the video, subscribe, and leave a comment to stay connected and help this channel grow. And if you want each new research delivered directly to you, join the SciFlux newsletter. The first paper talks about human fertility patterns reveal a puzzle. Pre-modern elites had many children for dynastic survival, while modern elites focus on quality, having few. Modern societies also show a U-shaped curve. The poor and very rich have more children than the middle class. Researchers explored the causes of these contrasts. Using a computational framework combining dynamic programming and Monte Carlo simulations, they introduced cognitive heterogeneity to model class-based belief differences. Their hybrid model separates rational survivors, poor, acting on real-world risks, from biased strivers, middle and rich, influenced by skewed perceptions. Key findings: having more children is rational when risks are high, making the modern quality strategy fragile. The middle and rich are caught in a two-stage belief error. A causal error underestimates dynastic risk, and a marginal error undervalues extra children, creating low fertility. The U-shaped fertility curve arises naturally, with the poor maintaining higher fertility while the middle class restricts theirs. This study shows how perceived realities and cognitive biases shape reproductive decisions, offering a unified explanation for historical and modern fertility patterns and their societal consequences. Next paper. Persuasion is central to human interaction, whether a doctor explaining a diagnosis or a politician campaigning for votes, but real-world persuaders often can't fully commit to showing all their cards. Traditional economic models of Bayesian persuasion assume a sender can commit upfront to a specific information-sharing strategy. Yet in practice, a salesperson, prosecutor, or doctor may acquire information dynamically, without being able to promise how it will be disclosed. This research models a sender who privately gathers information and chooses what to verifiably reveal, while the receiver doesn't know how many experiments could have been run or what might be withheld. Despite this asymmetry and lack of commitment, the study finds that the sender can achieve the same optimal payoff as if they had full commitment power. Persuasion remains just as effective. These results reshape our understanding of strategic communication, showing that even without prior promises, senders can influence beliefs and actions effectively. The findings have broad implications across economics, politics, marketing, and law, highlighting how nuanced information management can substitute for formal commitment in persuasion. Next paper. Decision-making often hinges on prior beliefs, our assumptions about the likelihood of different outcomes, but in many real-world situations, reliable priors are hard to establish, leading to fragile choices. This study addresses that challenge by introducing a prior-free framework for robust decision-making under uncertainty. Instead of relying on a fixed prior, the approach uses partial identification. The decision-maker considers all probability distributions consistent with observed signals and ranks options by their worst-case payoff. This ensures that the chosen action performs reliably even under the most unfavorable scenario. Remarkably, the framework shows that robust decisions can be implemented through simple information structures, withholding at most a single dimension of information, making exhaustive data unnecessary. Applied to causal inference, it demonstrates that desired treatment effects can be achieved while maintaining robustness without precise priors. This research provides a powerful tool for designing policies, experiments, and AI systems under deep uncertainty. By prioritizing worst-case robustness over assumed priors, it enables resilient decision-making across domains where foresight is limited, empowering choices that hold up across a wide range of possibilities. Next paper. Financial forecasting is notoriously difficult due to noise, rapid change, and unique market patterns. This study investigates time series foundation models, TSFMs, inspired by large language models, As a new approach to learning broad patterns from vast financial datasets, the researchers conducted the first comprehensive empirical evaluation of TSFMs in global markets, testing off-the-shelf pre-trained models, fine-tuned models, and TSFMs trained from scratch solely on financial data. Results showed that generalist models failed in zero-shot or fine-tuned settings, whereas models pre-trained from scratch achieved significant gains in forecasting accuracy and economic value. Performance further improved with larger datasets, synthetic data augmentation, and careful hyperparameter tuning. The study demonstrates that domain-specific adaptation is crucial for foundation models in finance. Simply scaling generalist models is insufficient. Understanding the language of financial data is key. These findings open a path for TSFMs to transform market prediction, risk management, and portfolio optimization, bringing us closer to decoding the hidden dynamics of global financial systems. Moving to the next paper. Understanding market sentiment is critical in finance, yet classical AI may miss the deeper nuances embedded in language. This study explores a quantum-inspired approach, developing the quantum distributional compositional circuit, QDisCoCirc, to classify financial text as positive, negative, or neutral. Because full-scale quantum computers are not yet feasible, researchers simulated quantum circuits classically. Sentences were split into chunks, each mapped to a shallow quantum circuit generating quantum tokens, block vectors. To retain grammatical and sequential information, a classical transformer encoder processed these tokens, augmented with CCG-based type embeddings for deeper linguistic context. Results showed this hybrid quantum classical system outperformed simple baselines, accurately identifying sentiment and focusing on key textual chunks. Correct predictions relied heavily on the richer type embeddings, emphasizing their value. This work demonstrates the potential of quantum language processing for financial applications, enabling more precise sentiment analysis and market insights. While challenges remain, such as building more integrated quantum circuits, the study points to a future where quantum AI enhances our understanding of complex financial language and investor behavior. Moving to the next paper. Investing can now go beyond wealth accumulation to actively supporting environmental sustainability. This study integrates carbon-conscious decision-making into portfolio management through a novel, environmentally penalized proportional portfolio insurance (PPI) strategy. The model maximizes expected utility while penalizing the terminal cushion proportionally to the realized volatility of carbon-intensive holdings. Using geometric Brownian motion for asset dynamics and stochastic filtering to address partial information, the researchers formulated a robust optimization framework. Results showed the strategy effectively reduces carbon intensity in portfolios without sacrificing financial performance. It performs under both full and partial information scenarios, quantifying utility loss from incomplete market knowledge. This work provides a practical blueprint for investors to align returns with environmental responsibility, demonstrating that sustainability and financial prudence can coexist, paving the way for investment strategies that genuinely drive planetary impact. Next paper. Debt recycling transforms home equity into a tool for faster mortgage repayment by leveraging property value to finance new investments. This study examines its real-world viability, factoring in interest rates, borrowing costs, and tax advantages across different countries. Researchers built a sophisticated simulation model calibrated with data from Australia, Germany, and Switzerland, accounting for mortgage dynamics, equity-backed borrowing, and tax shields. The analysis revealed that positive interest rates without tax benefits shrink the feasible success regions for debt recycling, while tax shields partially offset these constraints. Rental properties consistently outperformed owner-occupied homes due to more favorable tax treatment. The study underscores that debt recycling isn't universally effective. Its success depends on specific economic and fiscal contexts. By highlighting these nuances, it offers homeowners and investors a data-driven framework to optimize equity use, accelerate mortgage payoff, and avoid costly missteps. Thanks for watching. If you enjoyed the video, please like, comment, and subscribe. Also, join our newsletter to stay informed with the latest discoveries shaping science and innovation. See you tomorrow with a new round of breakthroughs. Take care.